On the EA exam, statute of limitations really means two different clocks. One clock limits how long the IRS has to assess additional tax. The other clock limits how long the taxpayer has to claim a refund or credit. Same tax year, two different deadlines, and they don't always match. Your job is to spot which clock the question is asking about. Start with the general assessment rule. The IRS usually has 3 years to assess additional tax. The key phrase is 3 years from the date the return was due or the date it was filed, whichever is later. So if you file late, you usually give the IRS more time. This is why record keeping often starts with keep it at least 3 years. Now, the big exception they love testing, omitted income. If you leave off income that's more than 25% of the gross income shown on the return, the assessment period jumps to 6 years from the filing date. Notice it's about what was omitted compared to gross income on the return, not taxable income. That more than 25% trigger is an exam favorite. And sometimes there's no clock at all. If no return is filed, there's no limitation period for assessment. Same result if the return is fraudulent. That's the IRS's way of saying you don't get the benefit of a deadline if you never start the process or if you cheat. On questions, fraud or no return should immediately scream no limit. Now switch to the taxpayer's refund claim clock. A claim for credit or refund is generally timely if filed within 3 years from when the return was filed or 2 years from when the tax was paid, whichever is later. That whichever is later matters, especially when payments happen after filing or when a return is filed very late. Two timing quirks show up a lot. First, early filing. If you file before the original due date, the 3-year refund period is treated as starting on the original due date, not the early filing date. Second, extensions. If you file on extension, the 3-year period starts when the IRS receives the return. So early filing doesn't start the clock early, but late filing usually does. Here's how this hits real life. Delinquent filers often lose refunds. If someone files multiple old returns today, they may only get refunds for the years still open under the 3-year refund statute. Even if withholding covered the tax, the refund can expire. On the EA exam, watch for facts that say delinquent filer and then ask, which years are still within 3 years? Malik is an enrolled agent with 20 tax preparers who work for his tax preparation firm. How long is Malik required to keep payroll tax and employment records related to his employees? The options include 7 years, 4 years, 10 years, or 3 years. Think about it. The correct answer is a minimum of 4 years. Payroll and employment tax records are generally kept for at least 4 years after the date the tax becomes due or is paid, whichever is later. 3 years is tempting because it's the common income tax assessment rule, but employment tax record retention is longer. With regards to federal taxes, the statute of limitations for assessment refers to what? The choices include collection time, disbarment time, felony prosecution time, or the time to assess a deficiency. Think about it. The correct answer is the maximum time period in which the IRS can assess a tax deficiency. Assessment is the act of formally recording additional tax due. Collection is a different concept with its own rules. So if you see assessment, think how long to add more tax, not how long to collect.